Hello students and welcome back to the second lecture on your specific loans. So this is now the last part of the type of question that I can ask you. I just quickly want to take you back to the beginning of the slideshow and highlight that we've said that I can ask you different types of questions relating to specific loans. And we said the first type we can ask is the simple interest, which I covered in the first video. Then we spoke about if a specific loan is paid off in installments over a period of time, which we also covered. And now we're going to look at a situation where the entire loan is paid off with a once-off payment at some point in the future. In other words, I get a R1,000,000 loan now, and then 3 years from now, I need to pay back the whole R1,000,000 at basically on one shot. So in one shot, you need to go and pay it back. Then in this instance, I also set up an example for you, which brings me to this a second lecture that I would like to explain. This is quite interesting, and I have again made up a example, and it says again that entity B obtains a specific loan of 98,500 Rand, and the loan is obtained on 1 January 2021. The loan is used to set up a new manufacturing plant, and this is a type of qualifying asset if you look at the theory of IAS 23. The construction of the plant started on the 1st of January 2021, and it will take 2 years for the plant to be constructed. So this is again 1 January 2021. It's a very, very important date because it tells us how long interest can be capitalized for. And if it is a timeline, it will start here, capitalization on 1 January 2021. I'm just going to make 21, and then it will end in the 31st of December 2022. So for this whole period, we can capitalize the borrow cost or the interest, which means that the interest portion will become part of the historical carrying value of the asset. All right, so the loan will be paid off after 3 years. So please note the word after 3 years with a once-off payment. The market rate is 14% and the loan carries an interest rate of 13%. So this is typically how you know that you are now busy with a payment in the future. So they tell you it's a once-off payment, and then you have two interest rates. You have the interest rate that is carried by the liability, and then you have the suggested market interest rate for that liability. So we start by saying the future value is 98,500 because this is the amount that I will have to put down after 3 years have lapsed. I need to once shot give them 98,500. And that will be after 3 years. The I will always be the market rate. So please remember that the effective rate is the market rate, and you need to use an effective rate when you calculate your borrow cost. Then the payment refers to the interest that is actually paid. So I just call this the actual interest. And the actual interest is the payment that you will type into your financial calculator. So that is the loan amount, the total loan amount times the interest rate that is carried by the loan. So it's that 13%. So the effective rate is the market rate, and the payment is based on the actual interest that is paid every year. You will compute your present value, and you will get to a present value of 96,213 and 19 cents. Then they tell you that the company has a year end of 31st December, and then depreciation on plants are written off over 5 years on a straight line method. So this is also quite important because this is how we can integrate IAS 16, which is PPE. That's how we integrate it into this type of question. Then the last bit of the question again gives you the progress payments. You will remember progress payments are payments that you make to the person who is your contractor, and you can see that they have made 1, 2, 3, 4, 5 payments, 3 in 2021 and 2 in 2022, and all of the payments was 19,700 Rand at a pop. Then in terms of your calculations, after you've typed in the information relating to your future value, your time, your effective rate, your interest payment, and you've calculated the present value, you will be able to retrieve the amortization table from your financial calculator, and the amortization table on your financial calculator will look like this. So I just drafted this from my sharp, and this is what the amortization table looks like. Of course, we need this amortization table. It enables us to do our journals. Let's look at the journals for the first year, which is 2021. This is quite interesting. So we're going to start with, we increase the bank by the loan amount, because the loan amount, the amount that we are getting in our bank account is 98,500 Rand. Now, something that is very interesting is these two entries, and they relate to borrow cost, but it also relates to IFRS 9. So IFRS 9 is a topic or a standard that we are going to cover later this year. But IFRS 9 says that you need to recognize a loan instrument at its present value. So I have now gone back to my financial calculator, and the present value that I've calculated here is what I need to put in as my loan amount here. So you will find that this doesn't balance because the bank has paid the full loan into your bank account. IFRS 9 says you need to recognize your loan at the present value. So now we need a balancing figure. And this balancing figure is a figure that will either be a loss or an income. Here we need a credit entry to make it balance, so we call it gain on loan amortization, and this is a profit account, and it will be taken to other income when you put or when you construct a statement of profit or loss and other comprehensive income. If you required, it can be in some instances you require a debit entry, then it will be called loss on loan amortization, and it will then be an expense, and it will be listed as an other expense in the statement of profit or loss and other comprehensive income. So normally this is a tricky one that students get wrong. So please make sure that you follow the rule that the loan instrument should be recognized at its present value in the instance where you will pay later with a once-off payment. Then, of course, we have recognized our progress payments. Please remember that a progress payment is debited to the type of qualifying asset, so it forms part of the historical cost. And during the year, we have made 3 progress payments that I have posted here for 2021. And then the last part is where we will recognize our interest. So for this, we use our amortization table. We will recognize this interest and we will recognize this payment. Please remember that in year 1 and year 2, this is a qualifying asset. So I'm just going to make a Q. In year 3, it is no longer a qualifying asset because they say it takes 2 years. It takes only 2 years to construct this plant. So after 2 years, we will commence with using it. It will be ready for use. And then we can no longer take the borrow cost or the interest and put it as part of the asset's historical carrying value. So just beware. So how do I recognize it? I recognize my interest against the historical cost of the asset. So I don't call it interest expense. I call it the name of the qualifying asset. And then I put it against the loan. And then I make my payment. Please note that students have said to me before, but ma'am, you said we don't make any payments. The payment is in the future. Yes. But remember, this 12,805 Rand doesn't relate to the actual capital that they have lent to. So it refers to the interest. How did we calculate the 12,805? We took the loan amount at its interest rate. So this is the actual interest, and you indeed have to pay the actual interest. So even if you're not repaying the capital of the loan, you still need to pay the ongoing interest. And that is what we are doing here. So we're not really making a payment towards the loan per se, but we are making a payment towards the interest. But as you can see, the interest is capitalized against the loan. So here we pay off our actual interest, we capitalize our amortized interest, we show a payoff of the actual interest. And this is how we recognize it from our amortization table. Right, for the next year, I've done pretty much the same. There were 2 progress payments on different dates that I've recognized against the historical cost of the asset. Then came a payment. So it's the second year, and at this date the asset was it was a qualifying asset up until this date. So therefore I put the interest against the historical value of the asset, the historical carrying value. Again, I put it against the loan, and then I showed the actual interest payment against the loan. Please note, in the third year, this asset is no longer a qualifying asset. So therefore, we now call this either finance cost or interest expense. And this amount will now be your interest expense in the third year, because it is only a qualifying asset for 2 years. Where did we find these amounts? I found them in my amortization table. So I accounted for these two amounts in my second year and these two amounts in the third year. Right, wonderful. Then the last entry that will be required is the depreciation, because we stopped with the construction of the asset on the 31st of December 2022, and therefore the asset came into use 1 January 2023. So at the end of the year, we've already used this asset for a whole year. So I've taken the loan amount for which the loan amount that I have used for this asset. And if you want to check if this amount is right, you can actually go back to the progress payments and add up all these progress payments, and they should give you 98,500. All right, so this total is this total that we have put here. Then I've added the interest of the first year and the interest of the second year. Remember, the third year, it was no longer qualifying asset, so we couldn't put the interest against the historical carrying value. I divided it by 5 because that is the depreciation method, and we've used it from 1 January 2023 to 31st December 2023, which makes it 1 full year. And that gives you depreciation of 25,106 Rand and 56 cents. All right, thank you so much for watching this video. I really appreciate it. Please also make sure that you watch the videos on the question explanations, where I have taken old questions and I have put them on a video so that you can see my explanations on Excel. I think that would also help you a lot. So I will catch you in my next video. Keep well until then.